Chinese markets rose on Thursday as government data showed factory activity growing in June for the first time in 4 months. That's as authorities lifted a strict lockdown in Shanghai, buoying growth in production and new orders, and as a rebound in the services sector is pressing on. The official manufacturing purchasing managers index rose to 50.2 in June from 49.6 in May. The 50-point mark separates growth from contraction on a monthly basis, and the index has been under 50 since March. But while the Chinese economy seems to be gaining momentum, headwinds are still there, such as a still subdued property market, soft consumer spending, and a fear of recurring waves of infections. For more on this now, let's go to Stephen Innes, who is SBI Asset Managing Partner in Bangkok. Many thanks for being with us this morning. Stephen, first of all, officials said that the Chinese economy would actually rebound quite quickly from their lockdowns. Is this then a definite sign that it will?
Put more stimulus in the market and we'll get what we refer to as a multiplier effect. But I think we're a little bit surprised by, positively surprised by the non-manufacturing PMI data. We've only had a couple of large cities that have opened. That number was actually quite strong, both in quantum and direction. And this sort of bodes well because we're going into, a reduction in quarantine requirements for travel and for inbound travelers in China. And this is actually being viewed quite positive, more so as a stepping stone, perhaps to a broader reopening narrative in China.
Right, so easing of these lockdown measures, but at the same time, as we were saying a few moments ago, I mean, manufacturers in China are really grappling with higher raw material costs and also slowing global demand. How do you think this will pan out in the next few months through the end of the year?
Yeah, no, totally. This is, if we look at where the consumer sentiment is sitting, I think manufacturing and also demand for manufacturing products around the world is going to catch down to that consumer sentiment, especially for exporting countries from Asia. We're starting to probably see that play out a little bit more in depth. But we have to look at China in a different light, perhaps, given the fact that their CPI inflation remains quite low relative to other countries. This offers them the opportunity to cut interest rates, and this is quite favorable, where other countries can't drop interest rates because of the inflation influx that they're facing right now.
Right, and just one question on that, on inflation. I mean, China's monetary policy has remained more accommodative when compared to other countries. I mean, can the country still afford that? Is the inflationary pressure really that different in China than it is in other countries?
But, they've still got ties with Russia, and they're still importing products from Russia, and they're importing oil at a discount. But at some point, that supply side inflation will eventually catch up. But in the interim, I think they're probably willing to allow a little bit of currency weakness to cut interest rates to drive that economy stronger. And this could be very, very positive for global markets, but we have to see how this interplay works out, because right now things look extremely doomy on the global landscape.
Stephen Innes, many thanks for this interesting update.
Thank you.